Obviously, there's always volatility in prices of any commodity. But what I did was I thought I ought to have a look at metals prices in the context of the longer term, and particularly silver. Now, silver has been behaving as an industrial metal, and I've got, if you like, a basket of base metal prices going all the way back to 1900. And if you price that in gold, that is quite revealing. Bearing in mind that over reasonable periods of time, and I'm talking about decades, centuries, millennia even, the purchasing power of gold is relatively constant. I mean, the reason for this is that gold is accepted everywhere as money, and unlike Bitcoin, the supply increases, and it increases at a rate which, while it can vary, is more or less in line with the global population. So you have a stability, if you like, when you price anything in gold. And we certainly saw this up until the point where the Bretton Woods standard collapsed. The point is that if you take the prices at the beginning of the last century, so we're talking about over 127 years, you can see this stability in a basket of base metals priced in gold. But interestingly, recently, the value of these base metals priced in gold has actually declined quite significantly. And this year, it's standing at a roughly 77% discount to that 1990 level. Now, it always returned back to that level. Sometimes it'll go over, sometimes it'll undershoot, whatever. But what that indicates is that irrespective of what's happening to fiat currencies and their purchasing power, these base metals as a package, we can expect them over a period of time, we don't know how long, to increase roughly 3 to 4 times. Now, that is before you talk about the debasement effect of fiat currencies on metals prices. Now, this is very important. What it tells us in a nutshell is that base metals are more underpriced than they have been in the last 127 years. 25 years, sorry. This is really quite something. This has significant implications. I mean, we're not just talking about base metals, but if we're looking at other commodities, you're going to get a similar sort of message. And therefore, the implications for consumer prices, let's say on a 5 to 10 year view, is that they're likely to go considerably higher. So the rate of inflation, if you like, even though the government suppresses the numbers, will increase. But returning to silver, silver has been priced like one of these base metals, and there's nothing in it at all in terms of premium for its monetary role. But I think that is also going to return because gold is very, very under-owned, and it's a racing certainty that as members of the public begin to catch up with what's gone on in gold, they will, at the margin, prefer to buy silver rather than gold on the basis that gold has already gone up and silver, has been left behind. So what we're looking at, in answer to your question, is silver is definitely on a tear and it's going to go considerably higher. And it's been doing it since I wrote that article, and I see this continuing. As far as gold is concerned, it's just been consolidating sideways. It's extraordinary how it's just moved sideways for the last, 2-3 months, consolidating and really providing a platform for the next rise up. In technical terms, we have what's called a pennant. Some would call it a triangle. And that triangle consists usually of about 5 legs. You go down, up, down, up, down. We're on the final down leg. And this actually coincides with option expiry for the August contract, which is on Monday. So I would expect to see gold drift off a little bit, but we're talking, 1-2% sort of thing. This is not. The other thing I would throw in is that this underpricing of metals as a whole is now leading to indigestion, if you like, in the papers markets. If you look at the best performing commodities this year so far, platinum, palladium, copper, silver, gold, it is extraordinary. And this is reflecting just how undervalued metals as a whole, precious or otherwise, have become. So anyone who thinks that there is going to be a decent reaction in gold and they're going to be able to get into it and all the rest of it, I think they're going to miss it, I'm afraid. And that's the way it is. It's very under-owned. If you look at the other way of looking at this is this is gold, admittedly. It's estimated that total portfolio assets around the world, global assets, are in the region of, I think the the 2023 figure was 270 trillion. If you look just at the ETFs, that represents less than 0.2% of that. I'm talking about global ETFs. Now, the reason I would say ETFs is that in most of the world, in terms of portfolios, you have got investment regulation, and gold is not a regulated investment. So it's actually quite difficult for an investment manager to put raw gold, physical gold, into a portfolio, because he's got to argue the toss with his compliance officer. And do you want to do that? No, you don't. So what you do is you buy a gold substitute. That is why I think that the gold substitute in the form of ETFs, which is a regulated investment, is a fair indication of the level of gold interest in portfolios. If you get some sort of crisis and a flight into the dollar, which is what happened in 2008-9, people haven't got the gold to sell. They'll sell something else. This is why I feel the downside in gold, because you account in dollars and you pay your taxes in dollars. And so from the point of view of whether you're up or down, your risk-free position basically is cash dollars. But this is all an illusion, because what you're looking at is credit. It is a credit risk, which depends on your faith in the Fed. And because it's a federal dollar, it's the Fed's dollar. And in turn, of course, the faith that you might have in the Fed is going to depend very much on the faith in the US government. Now, the reason that foreigners probably recognize this first and domestic users of the dollar recognize it last is obvious, because foreigners, from their point of view, their risk-free position is their own currency. So, let's say, a Brit investing in dollars or whatever, he sees risk because he is accounting in sterling. He pays taxes in sterling. He makes his profits in sterling. You can see that foreigners are a lot more sensitive to what's going on, let's say, in a foreign currency than domestic users. Domestic users, they don't actually understand, the difference between money and credit, gold being money and the rest being credit. And the second thing is that they assume that all the price changes they see prices rising. They think it's not the dollar going down in terms of its purchasing power. They think it's items rising, for whatever reason. I mean, they call it inflation. Actually, inflation is a description of what happens to the quantity of credit. It's a complete misnomer when you're talking about what's actually happening to prices. Prices are rising, they're not inflating. Now, that's a different thing. The only way to look at it really is to understand the dollar's value in transactions is not a constant. It is something that is moving all the time. And for a long time, it's been moving downwards. I mean, if you look at it in terms of, going back to 1933, you had $20.67 to an ounce of gold. Now you've got $3,400 to an ounce of gold. Well, what does that tell you? Does it tell you gold's gone up? No, it tells you the dollar's gone down. And we've had a constant stream of crises ever since 1933. And first of all, there was the devaluation of the dollar. I mean, this is an interesting one, because people will say, well, they rose the price of gold from $20.67 up to $35. Actually, what they did was they devalued the dollar by 40%. And then, of course, you had the Bretton Woods thing in 1971, driven off Bretton Woods. Nixon said he suspended it, to stop foreigners speculating and all this sort of garbage that politicians talk about when it comes to what they think is money. They were driven off it because basically what was happening is that as long as they fixed the dollar at 35 to the ounce, foreigners were just saying, well, here, you can have my dollars. I want the gold at that price. Thank you very much. From about 1947, 8, round about then, America had 22,000 tons of gold in its reserves. And by the time Bretton Woods was suspended, that went down to 9,000 tons. They were clearly running out. And, at the time, they were having to sort of sweep around, see what they could find left in the Fort Knox vaults. And, a lot of it probably wasn't actually deliverable into markets. So that's what happened. We've got